Well, as I've been highlighting, the lending for mortgages has been growing way faster than inflation, including for investor borrowers. And this is firstly lifting home prices because the growth in credit is one of the strongest levers of home price growth, alongside higher migration. And it also puts more households into high debt to income scenarios, while lifting typical repayments for many by perhaps up to 40% of income. The red warning lights have been flashing for months, and even the Reserve Bank recently warned of rising risks in the latest statement on monetary policy. And investor loans may prove to be a greater risk of default in a severe downturn. This was because investors are more likely to sell if they expect prices to fall, as the property was not their principal place of residence. APRA's latest data, released at the end of October, showed mortgage lending to investors was up 6.7% over the 12 months to $760 billion. Investors accounted for 38% of all mortgages in the 3 months to June 30th. Banks wrote $9.7 billion in new loans to borrowers at more than 6 times debt to income in the June quarter, which equates to 7% of new lending. Removing refinancing, the new flows of loans was 5.5%, which is of course well below the peak of 24% in December 2021, but is still way above inflation. The inflation data came out yesterday, and of course that has tended to close out the option of more rate cuts, with some analysts now suggesting the next move will be a rate hike at some point down the track. But now, the wet lettuce regulator APRA has said it plans to limit high debt-to-income home loans to constrain riskier lending from the 1st of February 2026, such that the country's biggest banks will face new restrictions on real estate lending, as regulators say they are preempting the risks that a sudden rise in interest rates or unemployment will collide with increasingly indebted families. APRA has said that it would impose debt-to-income limits on both owner-occupier and investor mortgages for the first time to stop the buildup of risky lending. The moves would restrict lending to the most stretched borrowers to 1/5 of new loans. They say that while overall bank lending standards remain sound, of course they would say that, APRA has observed a pickup in some riskier forms of lending over recent months as interest rates have fallen. Housing credit growth has picked up to above its long-term average, and housing prices have risen further.